Well, hello everyone. Welcome to this presentation. Now, you probably got here because you saw an ad that said, wanted to pay your house off 1/3 to 1/2 the time, here's how. And in this quick little presentation, well, I'm not gonna lie, it's not super quick, but it's gonna be about 30 minutes or so, maybe less, depending on how quickly I can get through the information for you. But I wanna say this as genuinely as possible. This one presentation has changed so many lives, and the reason why I am putting it out there, this is a product I sold back in the early 2000s with great success, helped tons of families. The market crash happened, things changed around, and it came back some years ago, and I'm jumping back in. Just to give you a little quick background on me, because it's not about me, I'm a multi-million-dollar producing real estate agent. I'm also a mortgage broker as well, so I'm very involved with real estate in general. And this, I'm an ex-retirement planner as well, so this sort of program and thing that you're going to hear and see about always had my interest. And I had a very similar background to the owners who created it. So without further ado, hang tight. Have your pens ready. We're going to go over some concepts and things of that nature, how this product works and how this product helps families get their homes and debts paid off super fast, how it's helping mine. I'm going to have a separate video that I'll probably leave a link somewhere down below that you can watch, where I actually walk you through my software program, because obviously I'm a believer in it. I have it myself. All right, so first off, it's called the Money Max account. And this is their little slogan is buying America back one family at a time, which I found pretty cool. It's just, the gentleman who started this company, and what appealed to me the first go around was just, they're good guys. They have a very similar background as me, very involved in real estate. They started in the mortgage industry back in '97. They were one of Utah's fastest growing companies for 3 years. And very quickly, and being in the mortgage business, I see it as well, they realized the significant importance of America's debt. I mean, it just, there's always, you're always getting pitched something on how to, make money doing this or that. But, for most people in America, if you don't get out from under your debt, it's very hard to get ahead. So what these guys decided to do, they saw people coming back and refinancing constantly, and it just didn't make any sense. They wanted to sort of create and solve a problem. So they launched a beta program in 2004, and they did a test on about 400 homes. And what they did was the average client ended up being like 20% ahead with this very, low-end kind of initial concept that they had. And they saw that people really enjoyed using it and had a good time. So fast forward some years later, I got into the company right around just after that beta test, and now they have over 70,000 clients, and that's actually growing, because this presentation is probably hasn't been recently updated, but it's getting. I know back when we were doing this before, there were thousands and thousands of clients that we had, and many of them are out of debt already, and the reflux of low interest rates and all that good stuff, more and more clients are coming back. But what was really cool is that I was in the company when they won all these awards. The Ernst & Young Entrepreneur of the Year award, they were in Success Online, True Wealth, Mortgage Planner, all these broker banker. They were on the covers. Like these guys weren't just creating something that might work, or some doodad that and then they disappeared later. Like, they made a huge splash when this came around, because here's the deal. It's math. It's made in a very simple fashion to help the client get out of debt quickly. And people were really, it almost sounds too good to be true in a sense, but it was one of those things that, it is just math. But the really cool thing is that those companies don't give out the awards unless you have great financials, you have longevity, retention, product viability, and an impact on customers. And there's surveys that get sent out, and they got all this stuff. It's the same award given to all these major Fortune 500 companies, which is pretty cool. You just think about that. They were a group of young men that came up with this concept and put it into put it out in the world to kind of see what it would do and how it would work, and we're starting to get a lot of recognition for it. So that's sort of when I came into this, was like in the beginning. And then what I noticed is there's always a disruptor in technology, okay? Because you're going to be thinking probably this whole time one of two things. Why haven't I heard of them, or something I can do myself? Well, there's a lot of people thought the same thing for many of the companies that you see on the screen right now. I mean, Instagram was nothing but a photo app that you would share photos with friends on, and then Facebook bought them for like some ridiculous $1 billion deal. Amazon was an online book purchasing company. Yeah, hello. Now they're everywhere. So there are companies that come in and kind of disrupt technology. YouTube, same way. The way people load up their own original content, and they're not stuck by the confines of what we see on TV. We're starting to see TV shift, and I know many of you are seeing that. So when we came out with this concept, it changed the way people started seeing how they spent money. You get a little financial education. You get a little, sort of vision board of what the end goal is, and kind of see the impact. Because here's what I will tell you: if anything's too complicated, people won't do it. If it doesn't serve its purpose, people won't do it. What the young man who created this company found is a mix of both. Is they made it simple enough to where it's easily understandable, and it can be used regularly, and the goal would be achieved. And that was the winning combination. So before we get into sort of entirely how it works, I want to make sure we're all on the same page. So I'm going to teach you a couple banking principles, sort of understanding terminology. And this is very common if you're in the mortgage industry or real estate or anything like that. You'll recognize some of this stuff. But I want to be clear so everyone knows when I'm referring to certain things that we're all on the same page. So there's 8 banking principles. There's closed-end loans, interest accumulation, mortgage amortization, interest cancellation, open-end and credit lines, float and leverage, offset accounts, and strategic debt payoff. So those are the 8 main things. Banks use these principles on a regular basis to make money. And we're going to go over each and every one of them, what they mean. So closed-end loans, number 1, is basically it requires a minimum payment of a full scheduled payment. It allows only payments in, nothing to withdraw. So closed-end loans are typically car loans and things of that nature. They're driven by an amortization schedule, which is very common. A closed-end can also be a mortgage as well. And any money applied does not affect interest charges until the following month. So those are very common traits. You calculate interest charges from the month-end principal balance. All right, so every month it'll, when let's say you're due on the 1st every month, so every 31st it's going to see what the balance is, factor in the interest, and that's how it calculates what portion of your payment goes to principal and interest. Okay, so number 2 is interest accumulation. So we're going to take an example here. Principal loan amount of $200,000. Let's say the interest rate is 6%. Now I know that's high by today's standard. We get it. But the reality is, you could just cut some of the numbers a little less than half, and it's still astronomical. But some of the other examples they use like 3.5 and stuff like that, so it'll be a little more. But a monthly payment on a $200,000 house is about $11.99 at 6%. Now, believe it or not, I bought my first house in the early 2000s, and I had good credit, and my interest rate was 6.7. So this is, some of this stuff is just, they already had the intel. So if you times that by 30 years, by 360, your total repayment, now yes, we know not everyone stays in their home that long, but just for sake of the presentation and kind of being upfront, your total repayment of that home would be $431,677. That's a big total amount. So basically you're paying your principal loan amount of $200,000 back, but your interest on that is $231,000. So you're almost doubling the amount that you're paying for that house if you stayed there for the term. Now, as I stated before, if we put it in lower interest rates like 4 or 3.5 or whatever it may be now, if those of you who have bought recently, it's still a significant amount. I did mine recently at 3.2. I'm still saving over $100,000. It's, so it doesn't matter. It just goes to show you kind of what sort of interest accumulation you'll get. So the real cost of your $200,000 home is almost $500,000 if you were staying there for the entire 30-year term. Okay, so and the reason that is, now if you look at the example, this is a $300,000 mortgage at 4%, which is more accurate. It's more real to kind of like what's going on now. But look, everyone thinks 4% is 4%. Well, not on a closed-end type loan. See, the reason is the banks know that we move every 5 to 7 years on average. That's a known principle, statistic, whatever you want to call it. Look it up. So what they do is they want to maximize their earnings early on. So if you look at what you're paying towards a mortgage and actually figure out what the interest is, the first year, your percent of interest and percent of your payment that goes to interest is 69%. I mean, it's astronomical. Because your payment is so front-end loaded with interest that very little goes to principal, which some people may know and some people may not know. If you ever got that stack of thick paper from your lender with the amortization schedule on it, it's usually the one you don't want to look at, because some of you deep down know. You'll see that of your $1,100 payment or $1,200 payment, like $100 goes to principal. The rest is all interest. It's crazy. So if you go all the way down 5 years in, it doesn't get much better. I mean, you're still at about 64% interest. So the majority of all your hard work is going to interest, and that is, that gets stiff. So what we like to do is kind of, how can we fix that? How can we change that? We're going to show you. But skip on down all the way to year 10, and you're still at 56% just about, which, I mean, good. You're thinking in your mind, 4%. That's not the case. It's 4% over 30 years. So, if you're not staying there for 30 years, your actual percentage rate, so if you're moving in less than 10 years and you're paying 55% interest. So that's how the behind the scenes real number is when you kind of look at it. And even when you go all the way down to year 15, it's 46.25, which, listen, you're halfway in and you're still sending that significant amount of money to interest only out of that payment. So it's frustrating. People tend to not want to look at this stuff because it's like, you just kind of come to the realization you're going to be stuck under a mortgage the entirety of your life. Well, there is a better way. It's not necessarily true, and that's why you clicked on the button and wanted to see what we had to say, because there is a better way. I can guarantee you that. So we're taking a look at the $200,000 6% interest example, and I'm going to kind of do the breakdown for you. So we have an $1,199 payment, $199 goes to principal, $1,000 goes to interest. It's silly, but that's just, listen, guys and gals, you can go amortization calculator online and fill in the information yourself, and you'll see it. Like I said, this is math. This is nothing that we can mess with the numbers to make it look better or worse than it is. It just is what it is. And if you look over the course of, like 7 months, 6 months here, the interest goes up only like $1 every month, which is sad. It's very sad. Which is why it takes so long to kind of improve your situation when it comes to that. So if there was a way we could accelerate that time and eliminate some of these interest charges, because look at the comparison. You have, in 6 months' time, you've paid in about $7,200. Only 1,010 of that has gone to principal. The balance has gone to interest. I mean, that's no wonder why we're not so thrilled. I mean, owning a home is great. It's a great thing. There's so many things we can go into about that, obviously, because that's an industry I'm in and I love. But when you look at what it costs you and how long it takes and all that stuff, it's a bit overwhelming. But basically, there's another way that we can do interest cancellation or format this program to kind of show you how you can save money. Okay, so let's take that same term. We're going to do, what if we put, with that same loan, what if we put a $5,000 additional payment on that first day instead of just the regular $11.99 payment? What does that happen? So our first payment is just $61.99. And this is talking about the number 4 subject, interest cancellation. I want to show you how this works, and we're going to show you how the program sort of helps you do that at calculated specific times. So what does that end up doing to your $200,000 loan balance? Well, if you send that in right at the beginning, it's going to bring your new balance down to $194.8. All right, so at the 6%, you still, everything else stays the same. The interest rate, the monthly payment stays the same. Nothing else changes. But here's the kicker. When you send the $5,000 of additional money as principal, your payment time goes down to 337 months versus 360. So you have essentially eliminated 23 payments or 23 months. What does that work out into dollars, you ask? Well, good question. After you pay that amount down to the 194.8, your new, let's say, okay, so now we're starting from month 2 to the balance of the time paid, your interest gets recalculated. So the new interest paid is only $208,373 versus the $231 if we had just stayed there and paid the same over the 30 years. So that is a savings or interest cancellation of $23,304. Now you're probably thinking there like, oh, that's, how many times if you could trade $5,000 for $25,000 would you do that? Now I know you're probably thinking, oh, Brian, I don't have $5,000 laying around. I get it. Don't worry. We'll get to that. But this is the concept of interest cancellation. This is the impact of doing something like that at a particular time, one way how you can accelerate that time. So what the software does, and this program will help you do, is it uses different open-ended credit lines and other types of sources to move money around and use interest cancellation and floating and all that. And we're just going to discuss concept 5, which is the open-end credit lines, and we'll get into how everything comes together. So an open end means that you have an ability to make multiple payments, withdrawals. Usually is like home equity lines of credits, credit cards, things of that nature. You can put money in and take money out. It's uses an interest factor to calculate interest. There's no amortization schedule, so it's usually like a revolving line. And then money applied today affects the balance today. So what it'll do is it'll take like an average daily balance, and that's what you end up paying in interest at the end of the month. Okay, so based on average daily balance. So just like I was saying, credit card, this is talking the concept of float and leverage. So how do we use interest float? Well, let's say you have a credit card, you go out and do all your shopping, put all your gas, food bill, all that good stuff on there. And then, or you have some sort of points card that you like to rack up points on. And then before the end of the month, you pay your full balance off. What did you do? You essentially floated the interest, and you leveraged your credit cards or lender's money interest-free for 25 to 30 days, and then paid it off before the bill was due, and you end up getting charged 0 interest. That's called float and leverage. Banks are really good at doing that and using that to the best of their advantage, because there is some power to that. Because maybe you only get paid twice a month, but you need to go grocery shopping early on or something like that. So there's a lot of different ways to do it, but you do float and leverage pretty much every day if that's a concept that you do. So we're going to show you how to do that also with getting out of debt faster with your mortgage, car loans, all those kind of things. Okay? So banks understand and use the concept of no stagnant money. Obviously, like the picture shows, there are tons of banks in every downtown area or city, and they're huge. So what did they do? How do they? What is it? The concept of no stagnant money that makes them be able to, garner the sort of wealth they have. Smart investors copy what banks do, because obviously the banks know when to move the right amount of money and at what time. They do they kind of shuffle money around from one account to the next. If you ever heard your bank doing what they call a sweep at the end of the night when they do, because they take our checking account and they invest it in other things, and so they're making money on our money. So because they understand all these concepts in a full way, so that they use the interest float, cancellation, all that good stuff, and they know how to move money around in order to make money. So just like I stated before, every day before the close of business, banks do a sweep from the checking and savings account to kind of invest into certain things, and then they put it all back. And they do this on a regular basis, and it allows them to earn a lot of money. That's why you'll occasionally get charged a fee monthly if you don't have a certain amount in your account, because it doesn't earn them enough money, which is crazy. But that's neither here nor there. But this is what they do. They use our money to earn interest for themselves while we sleep. So why can't we kind of figure out how to do it and do it for ourselves? That's the thing. They know money does not sleep. It works 24 hours a day, 7 days a week, 365 days a year. All right, hardest working thing out there is money. Now, I'm not saying focus all your efforts on just money, but when we don't use things to their fullest potential, it's a lot of times because we just don't fully understand the concepts, or we just didn't know. Well, that's why I'm here to kind of help you know, and what you decide to do with that knowledge is entirely up to you. But I gotta tell you, I chat with clients of mine all the time that are debt free, and they love it. And they freak out because it's like in disbelief. It's not a common thing. But we're going to show you how to bank like the bank. Okay? So, number 7 are offset accounts. Those are like home equity lines of credit, personal lines, commercial lines, secured lines of credit, even unsecured lines of credit, credit cards, and PayPals. Checkings and savings accounts. So there's like multiple concepts of how we're going to move money from one account to another. And I just want to let you know what an offset account is. That's usually, the offset account is where you're going to be kind of paying a lot of your bills through, and then you'll have another account that you do funds transfers through. So we'll expound upon that more. So let me give you kind of the concept of how the operating account works, or offset account they call it. So let's say we have $15,000 in a line of credit or a savings. Okay, so basically our mortgage is at 6%, home equity line is 10%. It's an open-end line of credit. Most people are like, why in the world would I use 10% money to pay off 6% money? Well, remember what I told you before. There are two different types of loan. One's closed-end, one's open-end. And your 6% is not really 6%. It's 69 or 67%. So yeah, it's not so cut and dry. That's the thing. We got to focus on what is the actual truth. So we're going to show you how that works. So you're going to borrow money from your operating account or offset account to pay down your first mortgage. And you're going to transfer $5,000 from either a home equity line or some sort of line of credit, and you're going to put it towards the principal of your mortgage. So now, here's how this interest and time savings works. So you remember we talked about doing this before, assuming it was your own money, and it saved us $23,304 in interest cancellation, which is epic. We're trading $5,000 for $23,000. All right, so we've just done that. Now we have we've eliminated 23 payments. We have a $5,000 balance on our home equity line of credit. Guess what that costs us? $50. Now, think about this for a second. Number one, I asked, would you trade $5,000 for $25,000 or $23,000? And most of you should say yes. But then when you're like, Brian, factor in the cost. If I said it only cost you $50 to do that, what's your answer then? Well, you're probably like, well, it's not going to just be 1 month. You are absolutely right. So let's keep it moving. Let's pretend like we have $4,000 of expenses, okay? And we have a $5,000 paycheck. So average Joe consumer, obviously we do an analysis to kind of put in your specific information to show you exactly how it'll work for you, but just as a general concept, let's just use this sample. And we're going to put our expenses on, some sort of SkyMile credit card or whatever. All right, so the paycheck goes to the home equity line of credit. So obviously that's going to pay down the balance that we had. All right, we're going to make our purchases with the expenses and everything that we have through that credit card that we're getting points. So we had a $4,000 increase on the credit card. Then we take $4,000 from the home equity line and then pay that off. Wait a minute, did you catch that? So we use the credit card interest free, and then we move the money back over to the home equity line. Okay, so this is where it gets tricky, is that this stuff, that's interest cancellation right there at its finest. And we're going to show you a couple months back to back how that all works. Now, the cool thing is with the program is that not everyone has just one set of debt. Most people have multiple different debts. You have your home, student loans, furniture loans, credit cards, multiple cars, all at different interest rates. And there's so many different people who give you different advice on which one to pay off first, never based on math. It's just whoever's podcast they heard that day, and they'll regurgitate to you. Here's a cool thing. The program tells you based on data and calculations which ones to pay off. It may be one with a lower balance so that you free up more discretionary income. It may be one with a higher interest rate. It depends, and it changes. If you have good months, bad months, it will change its process and what it tells you to do. And plus, who wants to sit around thinking about all that stuff? It's terrible, right? So no one has the system to do it themselves, especially you engineers out there, tax folks and CPAs. I get it. You have your Excel spreadsheet. You toss an extra 1,000 here and there and accelerate your time. That's great. That's better than most. But it is nowhere near in the realm of as quick and as effective as this program. So that's what I'm going to show you, because your Excel spreadsheet does not account for changes in lifestyle and changes in expenses. It is a fixed and static program, and that's it. So people don't live the same way, and plus no one has the time. Do you really want to sit around and fuddle around with numbers? It's nuts. Some people can do. I had a gentleman who actually was an engineer, and he created a very cool spreadsheet, and he did it, and he showed me he eliminated like 11 years off of he had 27 years left on his mortgage. I was like, that is awesome. Unfortunately, mine came in at like 5.2. And then I'd ask him questions. All right, you plan on going on vacation? He's like, yeah. I was like, where are you going? Europe? I'm like, all right, you know how much does it cost you? Yeah, about $5,000. I was like, how's that change your program over there? Just dead silence. Didn't know. I typed it in mine. It adds an extra 5 months to your payoff. What? And it took me 2 seconds. So, doing it manually is just rough. It'll kill your brain, and you'll end up not doing it. If everyone really wanted to do things manually, no one would have a GPS in their car. They'd be looking at maps. Nobody does that. So don't kid yourself. Too complex to navigate, and just the strategic payoff isn't always concrete. And we have the answer. We have a better way to do this. It's just like I said, it's a financial GPS. Life changes, things you need to reroute, go somewhere else, avoid, accidents or delays. That's what this program does. The program tells you how much money to move, the exact dollar amount, when to do it, and what account to move it from. So there's zero guesswork. That's the amazing part about it. It's not like you're having to try to interpret complex information. It's very easy. And it calculates the most strategic mathematical solution to zero debt, which is constantly changing as you update and fill out the information. I.e., what if you had a kid and you're out of work for 9 months? Or what if you had an increase in your job pay? How does that change your time frame? How does it accelerate or decelerate your payoff? What if you wanted to save for college and this and that? There's all these different factors that come into play that the program can take into account. That's what I like. It looks at every aspect. Your amount owed, the term of each, the interest rate of each item that you owe money on, payment amount, and income and expenses. And as they get updated, change, increase, decrease, it's going to recalculate. And that's the big plus. And then, like I stated before, it knows and will recalculate your journey if unexpected events happen, like medical bills, car repairs, just life stuff, right? Life stuff, COVID-19 or whatever it is. Your Money Max account is going to automatically recalculate your path to zero. That's just what it's programmed to do, and that's the great thing about it. It's just doing what it's supposed to do. So number 8 is the strategic debt payoff and cash flow. We're going to show you kind of again how this all works. So let's say we have a minimum reserve on our checking account, then we have our operating account that we usually do our funds transfers from. So you get your income, goes into checking, the balance goes up to accommodate, and then what you do is you use some of that money. It'll prompt you to pay down your operating account. You get your income again, it'll goes into your checking, and it'll tell you to pay down your operating account until it gets to what it considers a critical level or an optimal transfer point. And at that point in time, the software is going to say, okay, we're going to do a funds transfer, and here are all your debts. This is what we're going to pay off first, your motorcycle loan. So transfer X amount of dollars to pay that off first, and so on and so forth. So that's like a general concept of it. I hope you get that. Obviously, if it's a little too fast, we can go back over and cover it personally. So let's look at a monthly budget and kind of how this operates. So we're looking at monthly living expenses of $2,800.90. You have a primary mortgage of the $199.10 like we talked about. Total living expenses about $4,000. We're going to show you once again what and how this works in a sense of just seeing it on the screen with numbers, but obviously we would do that in a more personal level for you directly. So if your net income, because you can't spend gross, is $5,000, your living expenses are $4,000, we're using discretionary of $1,000. Listen, it could be $200, $100, it doesn't matter. It's just they're using this as just a general sample to show you. Because obviously any discretionary, some months you might have discretionary, some months you might not, it's going to vary, but just as a general theme. So this is sort of what the software looks like. This is your screen. What's really cool is if you look to where it says years to pay off, you have information at your ready of how long this is going to take and how much interest you have remaining and when you're going to pay it off, which is crazy and it's awesome. I look at mine at least once a week just cause. We're going to explain to you how this all kind of works. So that's years to pay off 9.9, interest remaining $67,000 and change, and then your potential interest saved is $164,000. So it shows you the breakdown when you first start off with all this stuff. Now, if you look, the home equity line of credit is already prompting this client to do a funds transfer of $63,8793 to their first mortgage. So it'll tell you home equity line to first mortgage. So that's what we're going to do, and this is how it's going to affect and cause this interest cancellation. So if we did that, actually, let me go back. You look at from month 1 to month 2, your principal contribution goes up $1. Remember that? That was a lot of fun. But if we do that $63,8793, it goes up $32 almost, which I know it doesn't sound like a lot, but let's take a look at it. That one funds transfer canceled almost $30,000, folks. That's insane. Eliminated 29 payments. So right off the cuff. Now, obviously, funds transfers are going to be different in timing for each and every person. Me personally, I set mine up to have $4,500 in my savings account as a cushion before it even does a funds transfer. So it's the first couple of transfers we're building that up, and then after that, I got funds transfers coming. So whatever you declare or determine, it's going to change and go that route. But just want to show you this as an example. So month 1, we have our offset account, which is usually what we pay all our expenses out of, and then we have the funds transfer that was scheduled. So now we have a balance of $10,387 in that offset account. Now, that could be a credit card, that could be a home equity line of credit, whatever it may be. But then we have our income that comes in. So now our ending balance is about $53,8793. Okay, you see how that works? So you put the whole check into that account. All right, and what that ends up charging you, and this is for you mathematicians that were noticing, we didn't calculate every month's interest. We're doing it now. That's $44.90 of interest that you're charged that month for a balance of $53.87. Okay, so that actually puts it. We add that $44.90. That's $54.32.83 is what's on there. We still canceled the $29,000 of interest based on that 6387 funds transfer. And so far that's cost us $44.90. Let's go on to month 2, because we've done all that and eliminated the 29 payments. That's already done. All right, so months 2 and 3, let's take a look. So now if we carried over the balance from the previous month, we pay all our expenses. It goes up to $94.32.83. Our income comes in. We go pay that all the way down. Then we have an ending balance of $44.32. Interest on all of that is $36.94. Okay, so then we add that interest. Now it's $44.69.77 is what the ending balance is. Month 3, same thing we've been doing before. The operating account has a balance of $44.69. We do our expenses, goes up to $84.69, and then we have our income that comes in. It brings it down to $34.69. Okay, $28.91 of interest. You see what's going on here? That discretionary income is making that ending balance go lower and lower and lower. Okay, so the software is calculating how much interest you're going to be charged on this offset account over the course of time to get that balance to where they consider an optimum level. So they know you're going to get charged this $36.28, but this is the fun part. Let me show you how this all goes down, because it's crazy. It's great. So same thing, month 4, we pay our bills, $74.98, income comes in, balance goes down to $24.98, and then the software says, hey, do another funds transfer, because we're low enough down to where we can kick another $42.31.62, and it will be that specific. I guarantee you, because I've already done one, and it was that specific as to what to the penny to do. I was like, okay, I'll do it. So you send it over, and now the new ending balance on that card or home equity line, whatever you're using to do this, is $67.86, because you were charged an additional $56.09 in interest. Okay, so let's add up the 3 months of interest. We're at $129.90 that we got charged interest on that offset account to cancel $45,666.31. Is this starting to make sense to you a little bit? You kind of see what's going on here? It is because when you do, your brain's gonna because it is such a cool concept that why don't they teach us this stuff? Well, that's why all the banks have the biggest buildings in every downtown. It's not in their best interest to let us know how they do business. You know what I mean? So leveraging borrowed money to save you thousands of dollars. Oh, we've eliminated 46 payments in 4 months, guys and gals. 4 months. We're not done. Let's go on. Let's go all the way down to month 7. Because the reason why we're skipping a month 7 is because month 5 and 6, it was getting that balance down again. So they're showing you month 7 is when the software is going to do another funds transfer. Okay? So the third funds transfer in 7 months, they have a good discretionary income, so that's why it triggers it faster. Obviously, if yours is lower, it'll be a little more spread apart. But they do another funds transfer of $39.11.04, charging $64.88 in interest. Let's look at the totals. So over the course of 7 months, the money borrowed when you were moving those chunks over out of that offset account cost you $320.23 in interest to save almost $60,000 and eliminate 61 payments out of your mortgage. I mean, really. Is this better ring your bell? I tell you what, especially after everything that's gone on in our country as far as, the debt crisis. This was going on when we were hitting the multiple trillions of debt. And there's a better way, folks. I hope you're not waiting for someone else to bail you out. Because I tell you what, it ain't happening. What you can do is you can take concepts that are being used by major corporations and learn how to do them for yourself. That's what we're showing you here. So let's look at this amortization schedule again. Month 5, we have 309 months remaining. Month 6, 308. And then we did that big funds transfer and eliminated a bunch of months again. So at month 7, we're at 183,796 of principal balance left. In month 8, we got $280 going towards principal. Do you guys remember if we rewind all the way back, month one, it was $200? So in 8 months' time, we raised that principal, shot out of that payment of yours of $11.99 to $280. So that's a $20.86 jump just from the month 7 to month 8, and then month 1 it was $199. So it was $81.02 over the course of from month 1 to month 8 as your principal contribution out of your $11.99 payment. Okay, so it by doing those big transfers, it skyrockets that contribution. We canceled the $59,000, eliminated 61 payments. So what does that mean? It's hard to digest, but that's reality. Like I'm witnessing happening with my own stuff. So this is what the dashboard will look like after 7 months. So you'll see years to pay off go down. You'll see interest remaining go down, and then you'll see what you've already paid off and saved with the $59,000, and then potentially continually moving forward, you're going to save another $164,000. So it's motivation. It's kind of neat because here's the thing: when you're doing, if you got your Excel spreadsheet or you're splitting your monthly mortgage payment in half and doing it every 2 weeks, cool. But it's not. You don't see the end game. You don't see it coming faster, and it's just hard to kind of get excited about it. You're just doing it sort of out of drudgery in a sense, and it's tough. All right, so we have the home equity line. You can see the next month coming up, there's another transfer and all that good stuff. So let's look at a side-by-side. What if average Joe consumer, after 7 months, their principal balance on their mortgage is $198,585. Well, the money max account consumer, they're at $183,796. So it would take the conventional person 5.7 years to get to the same place the money max account customer got to in 7 months. You're starting to get how we're able to pay these homes off quickly, how this works, how this can drastically change your life. You can stay on the 30-year plan or be on the 9.9-year plan. That's assuming you don't do anything better. You don't save any additional money. You don't get an increase in job or pay or anything like that. That's just assuming everything's static. You could pay $231,677 in interest or $67,000. I mean, this is a no-brainer. It really is. Those are your two options. And most people go with the terrible one because they don't know of a better way. Now you know of a better way to save money, eliminate 20 years off of that mortgage, and save $164,000. It's insane. So, we use home equity line of credits, personal line of credits, commercial line, secured line, credit cards. There's a ton of different ways to use it, but none of them are required. We can use just a savings and checking account and do it the same way. For some of you who just bought houses, you may not have the equity in your home to do a home equity. That's all right. You can use a checking and savings, and then as time goes by, if you have that ability, because you want to kind of use that interest float, you can. But it's not super required. It works the same way. In the checking, you're going to put in what a minimum reserve is so you don't put yourself in harm's way, and then you're going to have a savings account, and it's going to operate the same way. Income comes in, you're going to do a funds transfer when it hits the high reserve line, and it's going to go into your savings account, and then your savings account, once it gets to its optimal transfer point, it's going to do the same thing. Prompt you to do a strategic payoff on one of your debts that you have, very similarly to the offset accounts. It's just you don't have any interest cancellation or interest float in that scenario. So it'll change your time a little bit, but not too much, which is amazing. So basically, we're the first interactive debt elimination program. Connects with over 13,000 banks and lenders. It's web-based connectivity and it's secure. It just has general information anyway. I can personally tell you, they don't have, unless you link your banks, they don't have any personal information of yours. I call my credit card like Greenie One, and it just doesn't. If anyone gets it, they're just going to see that you maybe spend too much money on Uber Eats. But it has a lifetime program update at no charge, and it's just mathematical engines driven by complex banking algorithms and systems that these guys spent millions and millions of dollars creating. No magic, just math. That's the fun part about it. It's not like I'm just trying to sell you some magical, thing here. We're selling you a program that puts all these proven, tested, done over decades, hundreds of years, mathematical systems to work for you instead of someone else. Because, the cool thing is you got live client support. Something doesn't work right, you're not having some difficulty putting stuff in. Someone is always available to talk with you. Live chat, live training, online video tutorials as well, which is really nice, so you can watch it at your own leisure. And then there's online blogs and continuing education. Because you know what? When you get out of debt, what do you do next? There's always people there to help you. So, like it says here, over $19 million in development costs. Guys and gals, just because you didn't hear of it doesn't mean it didn't exist. Britain had something kind of similar called the One Account. Did you ever hear of that? Richard Branson created it. He's popular. Did you ever hear of that? No. I mean, Australia's got one too. Australia's been known to pay their homes off super fast. Do you know their programs? No. I know the internet gives us a lot of intel, but unless you're looking for it, you're probably not going to see it, right? So, join the crew. This ticker was taken as of January 28, 2020. So depending on when you're watching this, it could be old or not. But they've done over $2 billion of interest cancellation. I mean, these guys started this company to do this. This is what they did. And they've done it that much so far. Can you believe that? It's amazing. Do you want to contribute to that number? Or do you want to let your neighbors do it and try nothing or another way? I don't know. I just know that this is a life changer for many people. How many, think about it, how many people need this message? Do you want to be an emissary for life change? I mean, you can, but think about it for your own personal family first. For me, like I said, I'm big into real estate and mortgages and stuff like that. And, when they retweak the system and everything to work with a lot of different ways now, versus the old way, it only worked with a home equity line of credit. They came back and approached me and said, "Hey, it's back and running, and we want you to give it a whirl." And I was like, "Okay," and I bought it and put it out. I had no debt, and now, I'm an investor too. It monitors investment properties, which that's a whole nother video. I've already taken up enough time, but think about this: how many families do you want to help, or do you know that may need this kind of help? And to date, this is, you see the number, over $2 billion. I mean, it's too easy. There's too many folks that need this, and I hope you get it and see that it could provide value. So let me show you what it looks like, because we're all working together as a team to kind of convert debt into wealth and buy America back one family at a time, as it says. So I want to show you kind of what an analysis looks like, because that's the main thing. And those are free. They don't charge you to do an analysis. You just let me know you want one done, and we chat. And I put it in a program, and it kind of gives you an idea. My original analysis was 6.5-year payoff on a mortgage I have not sent in my first payment yet for. Due the 1st of next month. Now, when I uploaded all my information and updated everything, and I operated in it for about a month and a half, that time is now down to 5.2. Now, it could go up or down depending on what I do, but I used worst case scenario, and it still was ridiculous. Yeah. So we'll talk about the savings report. This is what it looks like in general. So basically, we get sort of your income, expenditures, and things of that nature, and we put it into this program that sort of calculates based on some of the algorithms that the program uses and does, and gives you somewhat of a summary of what you could expect. And listen, it's got to make sense. If it doesn't save you money, or it's not really good, or then don't buy it. It's free. Why not let the numbers do the talking, as it says here? Because it eliminates a lot of naysayers. There's gonna be a lot of people that tell you, "Oh no, you don't need to get nothing like that. You don't need to do something like that. You could just pay extra." That's terrible. Are they still paying a mortgage? It's not working great for them, are they? figure out where your information is coming from. But I wanted to point something out to you. So a lot of people always bring up that I never heard this stuff before. Some of you may or may not know this little example or ditty. Some of you in sales may know it. But this goes to show, FedEx has always had a little secret hidden in their logo. And you may or may not see it. But I wanted to insinuate that they're always on the go. And for years, I saw this and I never saw it. And until I went to some like sales training, seminar or whatever, and they pulled this little slide up. Now I see it all the time. So this will forever change the way you see things. And the point of me doing this is because you may not know or be familiar with all the banking concepts and things that we just covered. But once you jump on board and you use this program, you start getting it, you will never see things the same way again. That's the thing. You will be forever changed. It doesn't matter what stage of life you're in. Think about this. For those of you, my lovely baby boomers, who may be in 25 plus year mortgages and you're getting close to retirement. Like, do you want to have to deal with that until the fixed income is super fixed? Or do you want to potentially get out from under that before you get in there? I mean, it's just, I'll go on a rant. But look at that. See that arrow between the E and the X? That was there purposefully to insinuate being on the go. Now, you may have known that was there, and you may not have. But I guarantee if you didn't see it before, you'll never unsee it again. That's what I hope I did with you today. I want to thank you so much for joining me. And if you have any questions, concerns, or you want to do an analysis, or you want to maybe just have a little conversation about how this all works and operates, feel free to click links down below and send me content. I'm not a spammer, guys and gals. I'm not going to chase you down. You guys see what this thing does. There's plenty of folks that are going to want it. So if you want to get some information, I'd be more than happy. But just know, between the mortgages, the real estate, and this, I'm busy. I don't want to just, fool around. I got a little 1.5-year-old that I like to play around with too. So feel free, reach out, and I'll get back to you as soon as possible. And we'll see what it can do for you. Check out the other video down below when you have some time where I show you my own personal one. And man, I look forward to seeing you on the debt-free side. Because I tell you what, it's exciting and it's going to be fun. Take care. Thanks for tuning in. Brian Clark out.